Welcome to a video that I call the deep dive video, and I always want to explain what I mean by this. Each week I do a number of different videos, and I'll give you a list here in just a minute of those different videos. But I go through at the end of the week and I look through all the charts and I pick out those that really I didn't use in any of the videos. And the reason I call this the deep dive video is because we have to look a little bit deeper to see what is going on in these charts. And are we getting any insight from them? There are also some charts that are unique just to this video. This is being prepared for Monday, August 5th. I do have a thing called the SPX Investing Program. It is live. It's open for enrollment, at least for right now. And if you want to go to the website, it's free for the time being, although I will be locking it down in August. There is a link below this video that will take you to the website. There's also a link that will take you to a playlist where you can learn more about the program. Here's an email address if you see the need to contact me. As I mentioned, I do a number of different videos. This is the deep dive video right here. I also do a number of other videos once a week. The supplemental videos are more on an as-needed basis, but they all tie in to the central video, which is the daily video. That's where you really get the analysis. That's where you see things changing day by day, and you can often get a real good heads up when things are starting to shift, like we saw this past week. The first chart here is a chart of the VIX. Even though the VIX is invisible, this is a 50-period moving average. Over a period of time, this moving average helps us to see what kind of a range are we in. And we have dropped to a lower range. Although, as we've been going down, we're seeing pretty high readings in the VIX right now, and that's causing the 50-day moving average to go back up. But really, we just use this for informational purposes, just to give us some context of where is the VIX right now. We also do another study of the VIX, and then there's another, it's a VIX of the VIX, or VVIX. And we do a ratio between them here. And typically when this is going down, that tends to be positive for stocks. This has actually been turning and going back up as stocks have been under pressure. And even while they were still going up, we saw this starting to turn up as well. And this was giving us a little bit of a heads up as the VIX was starting to inch higher. We're also in a period right now with the VIX where seasonally and historically, the beginning of August going through about the beginning or middle or so of October, we typically see higher VIX readings. This, even though August is typically positive, September is one of the worst months there is. But then October can be really good or really bad, as history has played out with that. And so we see a lot of additional hedging going on. And when there's hedging, which means that people are in long positions and they're buying puts to protect them, which is something I do teach in the program, that makes this go up. That just means that there's more fear that's happening out there, and people are seeing the need to actually hedge to protect their positions. Okay, then we do a ratio between the VIX, which measures the volatility of stocks, and the MOVE index, which measures the volatility of bonds. And we're seeing them both really picking up right now. And in fact, the moving average has turned and is starting to go higher as stocks have been under pressure and bonds have been going up in price, which means down in yield. And we're seeing a bit of an increase in volatility there as well. I was showing this in the daily videos, and it seemed to be telling us something. We came up into this red area with the skew index. Now, this is kind of a variation of the VIX, where the VIX is calculated using at-the-money options. The skew index looks at out-of-the-money options. And when we come up into the red area, the market is just expecting some kind of a big move. We're not necessarily sure what direction that will be. You can see other times when we spiked up here and came down, sometimes it was a top, sometimes it was a bottom, sometimes it was a continuation. Where we were getting not real high readings here, but enough to get us up into the red area right before we started to see things really decline. Now, as we've been declining, we're no longer extreme with this indicator, and it's really been coming down. Also, kind of similar to this is a chart that I was showing pretty much every day there for a while. It's a correlation between the VIX and the S&P 500. It was getting above the zero line. Now, this tends to be meaning that the market is more nervous. And that's pretty much what happened here. We were getting an extreme reading. Then we started to come down with the S&P, and now we're seeing this correlation really drop off. Then just for informational purposes, how far are we above the previous all-time high set in early January 2022? Even with the declines, we're still 10.96% above the previous all-time high. Then stockcharts.com has this thing called technical alerts that can be rather helpful, and I go through them in the daily videos. This is for the whole week, and I don't even know if I got the whole list on here, but we started off pretty positive this week, and you can see a lot of blue or green here, a little bit of weakness in the NASDAQ and in Canada early on. But then as things just shifted, oh boy, did they ever turn negative, especially in Friday's session. We saw a lot of things just going down, down, down. Then stockcharts.com also has this tool where you can use it with a stock. I never tried it with a mutual fund, so I'm not quite sure. Usually, I think it would work better with something that has an open, high, low close, where with mutual funds, you only have an NAV, which is a closing price. But someday I'll have to try that out. But you can use this with a stock. You can use it with a sector. You can use it with an index, which is how I use it here. And I have 5 indexes. We look at the S&P, which is the foundation of what I do. We look at the NASDAQ 100, the mid caps, small caps, and the Dow. And then these are ranked on a score of 0 to 100. The higher the score, the better looking the technical scores. This is trying to remove emotion just by coming up with a mathematical way of scoring these indexes that I look at here and then ranking them from highest down to lowest. And believe it or not, even with the pullback, we have the small caps. Now, they really got hit this past week, and they're coming in with the highest score right now of 64.7. So if this is the highest score, I mean, when we're up in the 90s, that's when these indexes are strong. We're dropping down into the 60s. Okay, in second place is the S&P 500. It has some value. It's more diversified. It has 503 stocks in it, unlike the NASDAQ 100 and the S&P 100, and the Dow has 30. Well, this gives us some more diversification, and so it's holding up a bit better, even though it's been under pressure a lot lately as well, coming in second place at 55.4. Then in third place, also under a lot of pressure right now at 52.7 are the mid caps. And we have the Dow, which has dropped below 50 after not sitting not too long ago, an all-time high, just a week or two back. But it's coming in at 48.1. And then, which has been the leader for most of 2024, is now in last place, which is the QQQs, which are the NASDAQ 100. You can see we spent a long time in June and even into July, well above 90. This was the strongest index. Now it's really starting to see some weakness, coming in last place at 22. Okay, some short-term charts. We have a rainbow here going from 10 periods up to 50 periods. I like to look at about 3 or 4 years on this chart, maybe even 5 years, but just to kind of get a big picture look here. Now, even with the pullbacks, now, yeah, right now, Dorothy is somewhere under the rainbow here. We have dropped down below the rainbow, and the longer we stay down here, the lines are going to start to roll over, and this is doing some damage to our short-term trend. The longer we keep going down, the more the short-term trend has the potential of turning negative. If we can bounce up out of this and come back up into the rainbow and actually get back above it, that will really help the short-term trend longer term. I know that short-term, longer term. I mean, bigger picture look here. Okay, now we have another rainbow, and Dorothy's kind of near the end of the bottom of the rainbow here. This goes from 50 periods up to 100, a little bit slower, the intermediate term, where we haven't been in here long enough for the lines to really start crossing back over each other. But if we continue to fall, that's going to do some damage, even more than what we've seen. We were battling with the 50-day moving average. That was providing support until Friday. And then we came down, and now we're dealing with the 100-period moving average providing support. Are we going to be able to keep that? That's the question that we're asking. And then how far are we above the 200-day simple moving average? Even though we're declining, we're still 6.77% above the 200-day moving average. This just means that the long-term trend is still positive. Okay, then even with the fall that we've been seeing lately, we're still up 23.28% from the low that was set back in October 2022. And we didn't get an extreme negative reading, at least yet, with the CMB composite. It is going down and it's looking negative, but it hasn't crossed down below this black line. Also, a lot of gyration here with this Connor CSI or CSI. My goodness, I haven't watched that show in a long time. The Connor's RSI here. And we don't get a lot of extreme positive or negative readings here. Although it is negative right now, with the declines that we saw on Thursday and Friday, it's kind of surprising that this isn't giving us an extreme negative reading. Okay, the percent B, also negative, below the midpoint, but not giving us an extreme reading right now. We're still inside of the lower Bollinger Band. And then looking at the S&P 100, which is starting to underperform the S&P 500. It had been outperforming on the way up. Now that we're seeing more weakness, because these are the biggest stocks that make up the S&P 500, we're seeing more weakness right here. Even though we're not seeing a real divergence here with the charts, there actually is more of a convergence. They're going more in lockstep with each other. But when you look at this on a ratio basis, the S&P 100 is quite a bit weaker as of Friday. And a long-term rainbow here, just coming into the top end of it, and the lines are still going up. Yeah, we're under some pressure right now. This goes from 50 periods up to 250 periods. And so we're just going to keep an eye on this. Right now, it looks like your normal counter trend move in a longer-term uptrend. But is that going to change? I mean, you can watch other videos and you can read other things, and you've got the perma bears saying, okay, here we go. This is it. 80% decline from here. Or you can look at the charts and go, okay, we're just evaluating this as it unfolds. And for right now, we haven't even, it's a little bit over 5% that we've fallen. A real correction like we saw a year ago from the end of July until October was a 10% correction. And then we bounced up out of that. So is something like that similar starting to develop now? We don't know. We just watch it unfold day by day. Okay. Even though we're rolling over a little bit, our long-term oscillator, the special K, is still positive. Just to let you know, the weekly chart is still negative. It has never crossed back over positive. Then we look at a weekly chart here of the S&P and the weekly chart of the German DAX, and they're not really correlating right now. They had been going in the same direction. Europe has been under quite a bit of pressure, even more than what we're seeing in the US right now. And I don't have any support and resistance. I've been showing all those charts in the videos. And then this is the Vixen, which is like the VIX for the NASDAQ 100, really going up. We're seeing the VIX just skyrocket right now compared to where we've been before. And also because the NASDAQ 100 is going down, we're seeing a real escalation of values here with the Vixen. And you got to love that name. Then we look at a ratio. Here's the S&P on top. The ratios between the Qs, the NASDAQ 100 and the diamonds, which is the Dow, and they're all going down right now. So we're seeing a pretty strong correlated relationship here. Then we're also seeing some weakness in the Dow and weakness in the transports, which is not really a surprise. The hope was that if we are getting to an environment where the Fed's going to start to cut rates in September, maybe that'll help the transports. And if gas prices and diesel prices stay under control, maybe that'll help the transports. Well, everything's pretty much going down right now. Okay, rate of change charts. These are charts that I just show in this video. Going back 250 periods, we are declining just a little bit here. It's a little bit more pronounced. One thing that I did point out earlier on was that we got above this blue line. And sometimes it can go higher than this, but sometimes this was marking an extreme reading. And maybe that's some of the problem, at least longer term. Doesn't necessarily mean the trend is going to change. It just suggests that when we look at the charts that, okay, things needed to come back down to stop being so extreme positive. And looking at bonds, which have just been going up like crazy lately. And so we're looking at the relationship between the long-term bond ETF and the S&P. Well, you can see up here, the red line, that's the S&P, is going down as the long-term bond ETF is going up. Okay, and so the longer-term correlation is dropping off, and the short-term correlation is actually, they're having a tendency to go in opposite directions right now. We also look at the relationship between the Qs, the NASDAQ 100, and the long-term bond ETF. Qs going down, TLT going up, longer-term correlation going down. And then we look at the spread here, when we take the 10-year yield in the US and subtract the German 10-year yield, overall it's coming down, but US rates are still higher. And then we can plot the US dollar index here in the middle, and they're having a fairly strong correlated relationship right now. So if this keeps going down, the dollar was under weakness this past week because when interest rates are, it's thought that they're going to be going down. That means it costs less to borrow dollars and they're not as precious. So this relationship is something we just want to keep an eye on. But this is a weekly chart, so it takes us a while to actually evaluate this. Then we look at the yield curves. They are still inverted. This is another thing that we're waiting to see happen. On Friday, we had the employment situation report. It was much weaker than expected. And this has justified the Fed keeping rates higher for longer. It's like, look at the employment. It's doing fine. Unemployment's low. We're getting lots of new jobs. Well, now that could be in question. And that's part of what caused the problem on Friday. Even though we were down well below 1% with the S&P, even before that report came out, we just kind of kept going after Friday and just used it as justification. But this is kind of the area that's been holding up in the economy. If this starts to look weaker, we will look for these yield curves to go back to being regular at some point. And then usually that's when we start a bit of a countdown to see, are we in fact going to go into a recession? 5 to 6 months, maybe 12 months, maybe never. We don't really know how things are going to work out. We just want to watch it unfold. We don't want to make any, predictions right now. We let the charts tell us what's actually happening. Okay, this is also seeing a pretty big move here. We look at TIPS, which are Treasury inflation protected securities, and then do a ratio with the 3 to 7 year bond. Usually I show this chart because it doesn't do all that much. Well, look how this has really dropped off. That's because inflation worries are really starting to go down because it could be due to a weaker economy. And that's where bad news is becoming bad news. Up until about Thursday or Friday, bad news was treated as good news. It's like, okay, we're seeing some economic weakness, enough for the Fed to justify cutting rates in September, but that'll just spark up the economy. Well, after the employment report came out, it's like, oh no, maybe we better be more freaked out than we are already. And that really has caused this ratio to go down. Then I have these things called possible positive scenarios. The charts that I'm going to show you here, even with us declining, they haven't become helpful, at least yet. These were really helpful back in 2022. There's a number of charts that I do show in the daily videos. These are the rest of the charts where we look at the percent of stocks in the S&P above their 200-day moving average. And I have a different chart that I look at every day. We're still looking okay here longer term. We're above 50, even though this has been declining. Then we look at those stocks above their 50-day moving average, also declining, but still above 50. And we look at the mid caps starting to drop below 50 now as there's a little bit more weakness, and dropping, but still hanging in there with the small caps as well. So thank you. I know this was probably shorter than usual, but I'm using all the charts in the other videos. So anyway, after this, I will be preparing what I call the what to watch video. That's where I'm really honing in on the charts that are speaking to us right now. So I hope you are having a wonderful weekend, and I will talk to you in the next video.